Thank you very much, everyone, and really excited to be presenting today. I'll be talking mainly about alternative assets and WMA portfolio. So if we go to the next slide, please. Please familiarize yourself with the disclaimer and the next one. Before I start talking about the portfolio, introducing you to alternative assets, I just wanted to say a few words about Wilson Asset Management. It's a boutique investment manager specializing in investing in equities and other asset classes, predominantly via listed investment company structures, established by Jeff Wilson over 25 years ago, and has been growing successfully and delivering investment returns on behalf of over 130,000 retail shareholders in Australia. And the next one, please. We have 16 people in our investment team. We do work as one team, albeit there is always a focus on specific listed investment companies. Alternative Assets is the newest addition to our team and the newest addition to our business. We took over the management rights for the portfolio just under 3 years ago, and it's been going through a very interesting transition and evolution since then, which I'll talk you through. And on the next slide, brief introduction to WMA. It is quite a unique proposition for Australian retail investors. It's the only listed investment company that is listed on ASX and invests in a diversified pool of alternative assets. So anything beyond traditional asset classes would come on our radar when we look for new investment opportunities. The proposition for our shareholders and for our retail shareholders in Australia is about dividend yield, capital growth, and also very strong diversification benefits associated with those asset classes. We'll go to the next slide, please. So what are alternative asset classes? At times when I talk to our shareholders or other market participants, they do note that it is a very broad group of asset classes. In the context of WMA portfolio, we invest in private equity, unlisted infrastructure, and listed real estate, private debt, and real assets, which may include asset classes such as water rights, agriculture, and some others. The next slide, please. In terms of the themes and opportunities that I would look at when I select deals and select the assets for the portfolio, I do like to think about the universe opportunity set through the lens of investment themes. The reason for this is that those investments, they are long-term investments. When I make an investment in a private equity deal or infrastructure, the assumption or expectation is that those assets and those businesses will be there in 5, 10, 15 years' time. So those asset classes, they do tend to have long investment horizon. For me, as a portfolio manager and as an investor, it is very important to understand what are the underlying macroeconomic fundamentals. And my preference is to focus on those investment themes that have those strong long-term tailwinds. 4 themes that I'm more excited about versus others are climate change, growing aging population, growing demand for food, and digitalization. And the deals that I've been seeing this year in particular, they very much resonate with those themes. And I can talk you through some examples as well to illustrate how it works in practice. We go to the next slide, please. So why we think alternative assets are an important asset classes to be included in an investment portfolio. If we look at some large institutional portfolios, we can take as an example future funds, sovereign wealth fund. They have been investing in those asset classes for over 20 years. And if we look at their current portfolio, they invest over 30% of their portfolio in those asset classes. And there are good reasons for including those assets in the portfolio. They do have strong diversification benefits. They do tend to behave differently throughout economic cycles versus other more traditional asset classes. Some of them provide good inflation protection, good protection versus rising interest rates. They are long-term and they do tend to exhibit investment returns with low volatility versus more traditional asset classes. And investing in those asset classes for retail investors in Australia have been really difficult and nearly impossible, because when we talk about private equity investments or real estate or real assets, minimum investment ticket sizes tend to start from 10 million plus. So it does require significant capital to build a portfolio of those assets. They are illiquid. Not all retail investors can take this level of illiquidity, and they are really difficult to access. So it does require very strong relationships in the market, good network to access those opportunities. And from my perspective, bringing those investments into the portfolio that is structured as listed investment company is a really good opportunity for retail investors to get access to those assets and to those benefits. Next slide, please. To illustrate one of the points that we talked about, you see on your screens a chart that confirms the message or supports the message that those asset classes do tend to have low volatility. This is mainly due to their investment characteristics and also different approaches to how those assets are valued versus other asset classes. When we see in some of the asset classes valuations are affected and are changing on a daily basis, we don't see this trend, we don't see this change in alternative asset classes. The valuations do change, of course. This change tends to occur every 6 months or every year. So very different factors that are affecting those valuations, and different approaches to valuations do result in those smoother investment returns. Next slide, please. And next slide. I would like to talk about the portfolio before going into some of the examples within the portfolio. We have been focusing a lot on growing the profit reserve. So within listed investment company structure, profit reserve plays a very important role because it does provide some security or some comfort for shareholders when we talk about dividends policy. And the idea is to grow the profit reserve, increase dividends coverage ratio, and give some certainty to the shareholders about future dividends from this type of listed investment company. Another feature of the WMA portfolio and some other LICs in the market is that they do pay fully franked dividends, which resonates and is seen as a benefit by many retail investors. The portfolio has been delivering fairly stable, reasonable investment return of about 12% per annum. And we have started growing our dividends in the portfolio as well, with the board increasing the interim dividend to 2.5 cents. And that resulted in the annualized fully franked dividend for this financial year of 5.1 cent. Thank you. Next slide, please. So I'm going to spend a bit more time talking about the portfolio on this slide, I will explain what the slide means. So when we look at all those asset classes, they are included in WMA portfolio, and the term of capital commitment versus portfolio exposure simply means that when I commit capital to a new investment opportunity, it doesn't mean that it is deployed immediately within the portfolio. So that's quite a difference compared to other asset classes, such as listed equities, where if you buy a stock, you have it in your portfolio. Within asset classes like private equity, infrastructure, and others, it does take time to deploy the capital, and usually takes 12 to 24 months for these new investments to get full exposure within the portfolio. So very diversified portfolio. The thinking for me as a portfolio manager and as an investor in those asset classes is to create a good balance of risk and returns within the portfolio. I do tend to have about 40% of the portfolio invested in core assets, which are more income producing assets rather than growth assets. Those tend to be healthcare, real estate, core mature infrastructure, private debt, such as senior loan strategies, which lend money to well-established cash generative businesses. So again, in terms of the risk return profile, quite conservative compared to what I see in the market right now. And finally, real assets such as water rights. So those investments, they produced fairly reliable yield on the quarterly basis in terms of the distributions. And some of those asset classes, they do bring good inflation protection. If we take as an example, healthcare real estate, about 70% of income that I receive from those assets, they are linked to inflation. Very similar story about core infrastructure that we invested in, and that includes GDP-related assets such as transport, energy, renewable energy, social infrastructure, and it's an asset class that attracted a lot of attention from institutional investors, mainly due to the long-term contractual nature of the income returns that you receive from those asset classes. On the other hand, about 60% of the portfolio, I do tend to invest in growth assets. That would include private equity, more opportunistic strategies within real estate, agriculture, again, infrastructure. And those investments, they tend to focus predominantly on delivering capital growth. From my perspective, having the portfolio that is still in the process of deploying the capital in the current macroeconomic environment provides very interesting entry opportunities, because we do see valuations have been adjusting, in particular this year, across private equity, real estate, and some other asset classes. So from my perspective, in terms of the market definition, I definitely see it as a buyer's market for this type of asset classes. And the next slide, please. We provide a lot of education materials for our shareholders and for broader retail market, because we do appreciate those are relatively new asset classes to the broader market. And you can find a lot of materials and articles on our website, or simply reach out to us with more questions. Thank you.
Okay, that was very informative, Dania. I have a lot of questions to ask you, so let's just kick that off. This one here, what specific asset classes do you see providing the greatest opportunity in the short to medium term?
In the short to medium term, in terms of the entry point, it's definitely private equity at the moment. And I do see increase in deal activities this year. that's again on the back of my comment that valuations have been adjusting due to the increasing cost of debt, which does affect valuations, but also due to uncertainty in that macroeconomic environment. So when we talk about the private equity deals where we'd invest, they would be turnaround, transformation, corporate carve-outs, which when there is uncertainty, larger businesses, they do tend to restructure their businesses. So it does create opportunities. And also strategies such as mid-market buyout, where it's more about control stakes in the businesses and providing more capital, giving them more expertise and skills to grow and expand those businesses.
Understood. I think you touched on this earlier. Given the current state of the economy, both globally and locally, how does rising inflation and rising interest rate environment impact the fund and the investing criteria?
Great question. Look, for me, the starting point is those are long-term asset classes. So very important consideration for the investors in those asset classes is what's the entry point. A lot of the success of the future investment returns is determined by what price do you pay for those assets. So hence, like I'm mentioning, deploying capital within the current market environment across those assets can provide more upside in the future in terms of the investment returns. Look, from the inflation perspective and interest rate perspective, it's really important currently to understand how sustainable those businesses and assets are. Are they cash generative? What's the nature of their revenues? Who are their clients? And the tendency in the current environment is to look more within the sectors that are considered resilient sectors. So this would be healthcare real estate. This would be some of the energy sectors, in particular renewable energy. This would be, interestingly, technology, because that's probably the sector that experienced the most correction and valuation. Within technology, a lot of focus is on software, cybersecurity, AI software, and software that would serve sectors such as financial sector. So these are so far the sectors where we see most of the deals coming.
Fantastic. And look, given these alternative asset classes are not listed, how do you deal with the challenges around liquidity?
I would link this question to the structure of the portfolio. The reality is, when we talk about alternative asset classes, we usually have in mind 5 to 7 to 10 years investment horizon. In particular, if that portfolio is structured within an unlisted structure. And that was really one of the reasons, and has been one of the reasons, why retail investors were not able to access those investments. Because again, not many would be prepared to lock in their capital for such a long term. Now, listed investment company does create this interesting proposition where I, as a portfolio manager, have this perpetual pool of capital. It's a closed-end structure where I don't deal with constant capital commitments or redemptions. I look at this as a long-term portfolio. However, shareholders can have liquidity, which is simply buying and selling shares of that LIC. So when I look at my portfolio and the maturity profile of those assets, I do tend to construct the portfolio with an idea in mind that every year I will have some of the assets exited and recycle this capital into new investments. But at the same time, when I talked about that core part of the portfolio, I have long-term assets that produce those regular income returns.
Understood. And just one more to finish up. What sort of pipeline in terms of opportunities can you see coming over the next year or two?
Over the next year or two, gosh, it's a very broad opportunity set. So renewable energy is definitely an area of focus for infrastructure. So we do see this as an area of growth, and potentially we'll be having more investments made in this sector. Within private equity and real estate, those would be the sectors such as digitalization, so technology within private equity, and then healthcare across both. Within private equity, healthcare, an interesting challenge right now is access to labor. Everyone is fighting for labor. So looking for opportunities or businesses that are more positioned on the supply side of labor, that would provide future growth within the portfolio as well. And then potentially some of the real assets as well. So investment opportunities within agriculture and other, more esoteric asset classes.
Dania, thank you very much today for your presentation. Very informative. Have a great afternoon.
Thank you very much.
Thank you.